You can look at silver right now and you have essentially the same setup. So over the last 4 years, just quickly, the silver market is about 1 billion ounces a year of supply. About 85% of that comes from mining and about 15% comes from recycling. However, demand for this year and over the last 4 years has been well beyond supply. This year to the tune of 20%. So we're consuming 1.2 billion ounces, and yet we're only producing 1 billion ounces. So, people have asked, and I've asked myself, well, in this kind of environment, how come silver is not $50 or $60 or something, much higher? I had said that I expected $35 in Q4. We reached that earlier this quarter. I'm not surprised. It was quite the run up. If you look at, I think back in February, we were at $22. So that's, I think, something like a 45% gain. It's really pretty tremendous within this calendar year. So I'm not surprised to see it pull back a little bit. I do think that somewhere around the 28, 29, 30-ish is a floor. I have also said that I think that, once we make it meaningfully above 30, that 30 would become a new floor. So far, it's looking like that's kind of how it's playing out. So I think that, the odds are a lot more favorable for the upside than for the downside at this point in silver. And, I was talking about a little bit earlier about, doing research, understanding the market and so on. And I think one really, really good example might be for people to look at what has happened in the uranium market, because that's been pretty fantastic actually for over the last few years. It's become quiet, but at a much, much, much higher level. And, if you are interested and you pay attention and you look at what's going on, uranium has legs for the next, I'm going to say, decade and beyond. And it's comparable in a lot of ways. So I like to quote a really, really interesting thing from a really very smart guy, a highly experienced, really seasoned guy by the name Leigh Goehring. He's with Goehring and Rosenzweig out of New York City. And Leigh Goehring actually managed one of the world's largest commodities funds several years back. And so this guy knows what he's talking about. And so here's what he said. He said, 5 years ago, we became uranium bulls because the market had quietly slipped into a structural deficit and reactor demand had been outstripping mine supply. So what happened was fuel buyers used what we call so-called secondary inventories to fill the gap. So they didn't have to pressure miners to produce more uranium. They were able to tap into these secondary supplies, these above ground stockpiles of uranium, and drain those inventories. So Goehring saw this and he said, well, guess what? All these uranium miners have scaled back because prices had been so low for so long, about a decade, and production was, very minimal at that point, and there was no pressure on the uranium price because the consumers of uranium were able to go and as I say, drain these above ground secondary supplies. But what happened after that? So about 3 years ago, uranium was still at about $25, $27. Today, we're at around 77. We've been above 80, and we've been meaningfully around 80 for months, if not a year at this point. So I'd like to draw some really, really interesting parallels with silver. Because if you understand what I just explained about uranium and where uranium went and what happened with a lot of uranium stocks because of this triple in the uranium price, you haven't missed a boat, because you can look at silver right now and you have essentially the same setup. So over the last 4 years, just quickly, the silver market is about 1 billion ounces a year of supply. About 85% of that comes from mining and about 15% comes from recycling. However, demand for this year and over the last 4 years has been well beyond supply. This year to the tune of 20%. So we're consuming 1.2 billion ounces, and yet we're only producing 1 billion ounces. So, people have asked, and I've asked myself, well, in this kind of environment, how come silver is not $50 or $60 or something, much higher?
Silver has always held a special place in the commodities market, often regarded as gold's more volatile sibling. However, in recent years, the story of silver is increasingly beginning to mirror that of uranium, a commodity that experienced an extraordinary rally after years of underperformance. To understand the trajectory of silver, it's crucial to delve into the uranium market and uncover the striking parallels. About 5 years ago, uranium entered a bull market that many dismissed as unlikely. As Lee Goering of Goering and Rosenzweig put it, the market slipped into a structural deficit. Reactor demand for uranium began outstripping mine supply, but instead of pushing prices higher, the market relied on secondary supplies, above-ground stockpiles of uranium, to bridge the gap. This over-reliance on stockpiles masked the true demand-supply dynamics, keeping uranium prices artificially low. For nearly a decade, uranium prices languished, discouraging miners from ramping up production. But when secondary supplies began to dwindle, the true demand kicked in, driving prices from $25 per pound to over $80 per pound in just a few years. This near tripling of uranium prices turned early investors into winners and revitalized a market many had written off. The dynamics at play in the silver market today bear an uncanny resemblance to what happened with uranium. Over the past 4 years, the silver market has operated in a consistent deficit, with annual demand outstripping supply by approximately 200 million ounces. This year alone, global demand is estimated at 1.2 billion ounces, while production lags at around 1 billion ounces. Why hasn't silver already hit $50 or $60 per ounce? The answer lies in secondary supplies. Just as uranium consumers relied on above-ground stockpiles to fill the gap, silver consumers, industries like electronics, solar panels, and electric vehicles, have been drawing from identifiable silver reserves. These reserves are stored in entities like COMEX, the London Bullion Market Association, LBMA, and the Shanghai Futures Exchange, as well as in silver-backed ETFs. Since early 2021, these reserves have been steadily declining. Some have dropped as much as 70%, while others are down by 40%. Although this decline has plateaued in recent months, the trend is unmistakable. Secondary silver supplies are running out, just as they did with uranium. Silver's role in modern industry cannot be overstated. As a superior conductor of electricity and heat, silver is indispensable in electronics, solar panels, and a host of other applications. Solar panels alone account for a massive portion of silver's demand. As governments worldwide push for greener energy solutions, the demand for silver and solar technology is set to skyrocket. Moreover, the electrification of transportation is fueling another surge in silver consumption. Electric vehicles, EVs, rely heavily on silver for their wiring and batteries. As EV adoption accelerates, so will the need for silver. This industrial demand is not a passing trend. It's a structural shift, one that ensures silver will remain a vital resource for decades to come. Unlike uranium, where production can be ramped up relatively quickly once prices incentivize miners, silver faces significant supply-side challenges. Only 25% of global silver production comes from primary silver mines. The rest is a byproduct of mining other metals like gold, copper, zinc, and lead. This means that even if silver prices rise dramatically, increasing production will require higher prices for these base metals, a process that takes time. Further complicating matters, silver grades at many mines are declining, and new discoveries are becoming rarer. Research from S&P Global Intelligence predicts that production from primary silver mines will peak within the next 2 years. After that, global silver output is expected to decline, even as demand continues to rise. The parallels between uranium and silver suggest that the latter is on the cusp of a significant breakout. When secondary supplies of silver are fully depleted, consumers will have no choice but to rely on fresh production. This will inevitably put upward pressure on prices, just as it did with uranium. In fact, the setup for silver might be even more compelling than it was for uranium. Unlike uranium, which is primarily a niche market, silver serves both as an industrial metal and as a store of value. This dual role means that silver can attract investors from a broader spectrum, including those seeking a safe haven during times of economic uncertainty.
And you really have the exact same thing as what happened in uranium. You have secondary supplies, so above ground stockpiles of silver. These are the identifiable stockpiles are actually sitting at the COMEX, the LBMA, the Shanghai Futures Exchanges, and in some silver ETFs. Beyond that, you do have difficult to quantify private hoards of silver. So if we put that aside for now, we do know at least we can look at and see what's happening with these measurable secondary supplies in these futures exchanges. And since early 2021, these exchanges have seen their supplies drop from anywhere around 40% to 70% in the last 3 to 3.5 years. It's kind of gone a little bit sideways over the last 4 or 5 months, but for 3 years, from early 21 till early 24, they've been dropping very, very, very steadily. So here's the parallel. The big consumers, I believe the big consumers of silver, in industry, electronics, solar panels is the biggest one now, have been able to tap into these above ground silver supplies and buy silver, buy it at spot price, not put pressure on producing more silver to meet this excess demand over supply and feed their need. And this supply is only going to last so long. When that runs out completely, then we're going to see silver just absolutely explode. And I think potentially do something like uranium did, which was to triple in a matter of a couple of years, because there is very, very difficult headwinds in terms of trying to get more silver out of the ground. Ore grades are falling. Only about 25% of silver comes from primary silver mining. The rest of the mined silver actually comes from as a byproduct of mining gold, copper, lead, and zinc. And that's what we're facing. So if you look at that and you understand the setup, you realize that, and by the way, there was an interesting research by S&P Global Intelligence that looked at scrap silver from primary silver mines, and they think that will actually peak within 2 years. So true silver mines will actually start seeing output globally fall within 2 years. So the picture for silver supply is not rosy, but demand is super strong, likely to continue that way. And there's one thing, as we know in economics, lack of supply, strong demand means that the commodities price has to go up.
Silver's potential bull market isn't just a theoretical possibility. It's a likely outcome of the structural imbalances in supply and demand, economic instability, and the global shift toward renewable energy. When we analyze the myriad forces driving silver's price trajectory, the case for a historic bull market becomes even more compelling. Let's break it down further and explore why silver could be on the brink of an extraordinary rally. One of silver's unique strengths is its dual role as both an industrial metal and a monetary asset. This duality makes silver a standout commodity in the global market. On one hand, silver is indispensable in numerous industries, from electronics to renewable energy. On the other, it has historically served as a store of value and a hedge against inflation. As a monetary metal, silver offers a more affordable alternative to gold. When economic instability drives investors toward precious metals, silver often experiences outsized gains because of its lower price point and higher volatility. Historically, silver prices have moved in tandem with gold, but at a much higher percentage, making it a favorite among investors seeking higher returns during bull markets. The global push for renewable energy is perhaps the most significant factor underpinning silver's demand. Silver is a critical component in solar panels, which are essential for harnessing solar energy. As countries ramp up their renewable energy goals to combat climate change, the demand for silver in solar technology is set to soar. Consider this: the International Energy Agency, IEA, projects that solar power will account for more than 20% of global electricity generation by 2050. Each solar panel requires silver for its photovoltaic cells, making the metal irreplaceable in this application. According to the Silver Institute, the solar industry consumed over 105 million ounces of silver in 2023, a number that could easily double in the next decade. Additionally, the transition to electric vehicles, EVs, adds another layer of demand. Electric vehicles require silver for their electrical connections, batteries, and charging infrastructure. As EV adoption accelerates globally, the cumulative demand for silver from this sector will further tighten supply. While renewable energy and EVs are the most talked about drivers of silver demand, the metal's use in other industries is equally important. Silver's exceptional conductivity and thermal properties make it indispensable in electronics, medical devices, and even water purification systems. The 5G revolution is another factor. The rollout of 5G networks requires advanced technology, much of which relies on silver for its conductivity and durability. As 5G infrastructure expands, so too will the demand for silver. While demand for silver is poised to rise, the supply side tells a grim story. Only 25% of silver production comes from primary silver mines. The rest is a byproduct of mining other metals like gold, copper, and zinc. This means that even if silver prices rise, increasing production is not as straightforward as ramping up operations at existing silver mines. Compounding the issue is the decline in ore grades. Mining companies are extracting less silver per ton of ore, making production more expensive and less efficient. New silver discoveries are also becoming rarer, with exploration budgets focused elsewhere. A recent report by S&P Global Intelligence predicts that global production from primary silver mines will peak within the next 2 years. After that, production is expected to decline even as demand continues to grow. This mismatch sets the stage for a significant supply crunch. For years, secondary supplies of silver, stored in COMEX, the LBMA, and other exchanges, have helped meet excess demand, but these stockpiles are depleting at an alarming rate. Since early 2021, silver inventories on major exchanges have dropped by as much as 70%. Once these stockpiles are exhausted, industrial consumers will have no choice but to compete for newly mined silver. This competition will drive prices higher, creating a feedback loop as investors rush to buy silver in anticipation of further gains. The gold-to-silver ratio is a key metric that highlights silver's potential for outsized gains. Historically, this ratio has averaged around 15-1, meaning it takes 15 ounces of silver to equal the value of 1 ounce of gold. Today, the ratio is closer to 80-1, indicating that silver is significantly undervalued relative to gold. During previous bull markets, this ratio has moved closer to its historical average, with silver outperforming gold. If the ratio were to revert to even 30-1, with gold at $2,000 per ounce, silver would need to rise to approximately $67 per ounce, a more than doubling from current levels. The similarities between silver today and uranium a few years ago are striking. In both cases, secondary supplies masked structural deficits, delaying price appreciation. But once those secondary supplies dwindled, prices soared. In the case of uranium, prices tripled in just a few years as the market adjusted to the reality of limited supply and robust demand. Silver is now in a similar position, with secondary supplies depleting and demand from industrial and investment sectors increasing. If silver follows uranium's trajectory, prices could easily triple or even quadruple in the coming years. Physical silver, coins and bars, are the most direct way to invest in silver. They offer financial security and can be stored as tangible assets. Physical silver also allows investors to avoid counterparty risk. Silver ETFs. Exchange-traded funds provide exposure to silver without the need to store physical metal. However, it's important to note that owning an ETF does not equate to owning physical silver. Mining stocks. Investing in silver mining companies offers leverage to the price of silver. When silver prices rise, mining stocks often experience outsized gains. Look for companies with strong balance sheets and low production costs. Royalty and streaming companies. These companies provide upfront financing to miners in exchange for a percentage of future production. They offer exposure to silver with less operational risk. Silver futures and options. For experienced investors, futures and options provide a way to speculate on silver prices. These instruments offer significant leverage, but come with higher risk. While gold is often seen as the ultimate safe haven, silver's dual role as an industrial and monetary metal gives it unique advantages. During bull markets, silver has historically outperformed gold due to its higher volatility and smaller market size. This means that even a small increase in demand can have a significant impact on silver prices. Moreover, silver's affordability makes it accessible to a broader range of investors. As economic uncertainty drives more people toward precious metals, silver is likely to attract significant inflows, further boosting prices. The silver market is at the intersection of multiple powerful trends: rising industrial demand, declining supply, depleting secondary stockpiles, and growing interest from investors. These factors create a perfect storm that could propel silver prices to historic highs. But silver's story is not just about supply and demand, it's also about the broader economic environment. With inflation eroding purchasing power and central banks struggling to maintain credibility, silver offers a hedge against uncertainty. Its role as both an industrial metal and a store of value makes it uniquely suited to thrive in today's complex market. The silver market is approaching a tipping point. Once secondary supplies are exhausted and industrial consumers are forced to compete with investors for newly mined silver, prices could rise rapidly. For those who act now, the potential rewards are immense. As Peter Krauth often emphasizes, silver is the opportunity of a lifetime. The time to position yourself is not after prices have already surged, but before the rest of the market catches on. With silver, the upside potential far outweighs the downside risk, making it one of the most compelling investment opportunities of our time.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.